Five-day winning streak on the S&P 500, about 25 seconds away from the opening bell in New York this morning. Good morning. State of play, Microsoft, record high. NVIDIA, all-time high. The NASDAQ 100, a few percentage points away from a record, starting today at a 22-month high. There's your opening bell. Switch on the board and get to the bond market. Yields look like this, lower by a single basis point, 440.81 on a 10-year. My focus, shifting to foreign exchange. The euro, 4 days of strength, 4-day winning streak on the euro against the dollar, 109.56. That's the longest daily winning streak going back to July. The currency pair, the highest since mid-August, 109.56, and positive there by 0.15%. Turning to crude, we're negative here by 0.6%. WTI at the moment, $77 and about 32 cents. About 30 seconds into the session, equities on the S&P 500 pulling back just a touch. We're down 0.25%. The NASDAQ down by 0.5. One stock to watch at the open, Lowe's. The retailer cutting its annual forecast, echoing Home Depot's concern that a slowdown in big ticket spending will likely weigh on holiday sales. Abby has more. Hey, Abby.
Hey, John. And the stock right now heading to its worst day in about 2 months on that outlook being cut. Plus, the quarter that was reported was not stellar. It was basically in line, a small miss. Sales of about $20.47 billion, missed estimates by 2%. They put up adjusted earnings of $3.06. That was a slight miss. And the same-store sales declined for a fourth consecutive quarter, coming in at down 7.4% versus the estimate of 4.9%. So all of that setting the stage for then cutting the outlook for a second time this year. The company is talking about what you just said, big ticket sales not as robust as they had been. As you mentioned, Home Depot, and we also were talking earlier about Best Buy saying something similar. They're also saying that there's a slowdown in do-it-yourself demand and discretionary spending. So for the full year, Lowe's now sees same-store sales dropping 5%, worse than its prior expectation of a range of down 2 to 4%. It's interesting. Some analysts are saying that Lowe's numbers are a little bit less impressive than Home Depot's on the year. Both stocks down just about slightly.
Had some shockers in retail this morning. We'll talk about more of those in just a second. Abby, thank you. Just to touch base with the price action once again. A couple of minutes into this, we're down by 0.25% on the S&P 500. 5-day winning streak into this, but big earnings report coming out a little bit later from NVIDIA. Sticking with earnings, Baidu topping Q3 revenue estimates and reiterating AI investment plans to help drive future growth. Ed Ludlow has this story. Hey, Ed.
Yeah, good morning, Jonathan. So Baidu's down a percentage point on its US-listed shares, or ADRs, following the open. In pre-market, they had been as high as 1%. Overall, in terms of the financial results, basically in line with expectations. Overall, this is a Chinese technology company that is seeing pretty sluggish growth, but is able to extract some upside on the bottom line. The AI story is that Ernie, its generative AI tool, chatbot, akin to OpenAI's ChatGPT, is giving some support to the top line. Sales grew by around 6% to $4.8 billion from July to September, slightly ahead of expectations. And the narrative from the company is that Ernie, the chatbot from Baidu, is going to add some real top-line support in the coming fiscal year. There is a fierce battleground in China in the AI context. I think we know that. We talk about that. But in terms of taking that underlying technology, building large language models, creating a generative AI tool in the form of a chatbot, Baidu is giving some evidence that they're able to monetize that. And just like many other technology companies in this country, there is softness in Baidu's advertising business. And so this top line support, I guess, from the AI product is doing some work to offset that.
Ed, thank you. Stock down just a touch. We're negative here by 1.4%. No drama there. Let's turn back to retail results. Kohl's under pressure after reporting a 7th consecutive drop in comparable sales, pointing to weakening foot traffic and a shift away from consumer spending on discretionary goods. Simone Fox on the top of this story. Hey, Simone.
Hey, John. Yeah, and CEO Tom Kingsbury was just on the earnings call just now. Softer than expected demand environment. That is what he was talking about. In the third quarter, we saw comparable sales down 5.5% on a year-on-year basis. The expectation had been down about 3.5%. Talking about a decline in foot traffic. Kingsbury also saying he doesn't like to blame anything on the weather, but then going ahead and blaming bad weather in the Midwest, Mid-Atlantic, and Northeast regions for some of that. That said, the company, as we've seen some other retailers do, was able to outperform on the profit side. Third quarter earnings per share coming in at 53 cents versus the 36 cents that Wall Street had anticipated, and seeing earnings near the top end of their previous expectations for the full fiscal year, bringing up the bottom leg of that guide. It's able to seeing some positives on CapEx as well. It's undertaking a massive store refresh, building out its partnership with Sephora, but does believe that the money needed to do that will only be on the lower end of the 600 to 650 million that it was anticipating. Yesterday, however, we did get the announcement that the president's COO was out after just about 9 months. Bloomberg Intelligence saying that the silence on this has been awkward, also pointing out that the turnaround may take longer than expected, but this call is ongoing, so we'll see if we get any more details there in the coming minutes.
Getting hammered. We're down by about 9%. Simone, thanks for that. 22.64 in early trading. I said there was lots of bad news out there for the retailers. There's one bright spot. This from Dick's Sporting Goods. The stock is up by a little more than 8% this morning. That's probably a rare bright spot out of the retailers in the last 24 hours, boosting their outlook. Things look okay. Best day since March, potentially, for Best Buy, for Dick's rather. We're positive there by about 8%. Let's get to the bad news for the retailers. I mentioned Best Buy briefly then. Let's talk about it. Cutting its full-year sales forecast due to uneven demand for consumers ahead of the holiday shopping season. Katie Greifeld has this. Hey, Katie.
Best Buy currently down by more than 5% after missing estimates, cutting the outlook. Now, same-store sales, they fell more than expected. And remember, we saw a similar thing from the likes of Macy's, Target, and Gap just in the last couple of weeks. But unlike some of those other retailers, Best Buy isn't expected to preserve its profitability to the same degree. To go through some of the numbers here, sales this fiscal year now seen at $43.7 billion. That previous guidance was for $44.5 billion. Best Buy also lowered the high end of its adjusted EPS range by about 10% to $6.40. And like you said, that's really being driven by what Best Buy says is uneven consumer demand. Big ticket items seen as especially weak. That is similar to Lowe's, and the chain also noticed softness when it comes to home theater and computing. You add it all together and it's a pretty grim message going into Black Friday, John.
Katie, thank you. The stock is down by, let's call it 5% in early trading. We're about 6 or 7 minutes into the session. Broader markets down about 0.25% on the S&P. On the Nasdaq, we're down about 0.4%. If you want to turn to the bond market just briefly, it was what didn't happen yesterday. No bad news for the 20-year auction, which meant this bond market was supported just a touch. Yields came in just a little bit. On a 10-year, we're down by about a basis point. 440 on a 10-year. 30-year yields coming in, not even a basis point this morning. 456. Looking at a 2-year, down about 3 basis points. 488. This from Gershon Distenfeld of AB, weighing in on the Fed's road ahead. In the Fed's own words, there's still a long way to go, and progress remains slow. And they may be done hiking, but they aren't anywhere near cutting either. Gershon, I'm pleased to say, joins us right now for more. Gershon, with that in mind, looking ahead to this afternoon, 2 p.m. Eastern Time, what would you expect to hear from the Federal Reserve minutes?
You're going to hear a lot of balance, like you've heard the past few times that you've heard from the Fed. There's really nothing new here. They're trying to figure out, does it make, what's the future path going to be? And then we all sit there and look at, we look at the employment prints every month, we look at CPI, we look at manufacturing surveys, we look at all sorts of things. But they're trying to figure out where the puck is going. And the truth of the matter is they don't really know, right? Monetary policy, as we've spoken about many times before, has a huge lag to it. There's been a lot of tightening of financial conditions. We're starting to see some cracks there. At the same time that inflation is coming down, but not nearly to the level that the Fed wants it to. So the Fed's just not sure. If you ask them honestly, they don't know what they're going to do, but it's probably going to take some time to sort it all out.
I know there's a couple of relationships that you've been following, and you've kept us up to date every time we've talked about them. I've identified the two you often talk about, the relationship between the ISM and bond yields and Fed funds. Gershon, which of those relationships do you think is most relevant right now?
Look, I think in the long run, they're both relevant. I think that, as I've said many times before, this idea, we're going to see the 10-year, let's say, probably bounce in this 4 to 5% range. It's just not that. It's supported by the fact that, the Fed's admitting that they may not get back at 2%. Let's say they get 2.5%. Real rates, I heard a guest earlier said real rates should come down 100 basis points. I'm not sure. I think 200 has been the average of the past 100 years. So kind of a mid-4s on rates it makes sense. The forward curve is now pricing in that the Fed only cuts to 4% and then kind of stays there forever. So I think we're in a new regime. Just like we were in a regime of very, very low rates for many years, I think we're in, I wouldn't call these high rates, but kind of mid-level rates is what we're likely going to see in the coming few years.
Well, you've got two choices. One, stay in cash, or two, stay fully invested. Gershon, based on the price action of the last couple of weeks, is it the latter that you'd lean towards just a little bit more?
Look, I think you should always be fully invested. The reality is, unless you think that cash has a higher expected return than other assets, over time, you're going to do a lot better in other assets. We believe at AB that all the time you should be fully invested. It's very, very hard to time these markets. And yeah, the price action of the past few weeks shows that, a couple weeks ago, everyone thought the world was falling apart. And now, of course, people think things are much better despite some of the retail weakness that we've seen. So investors, they come and go in terms of their emotion. But, we believe one should be fully invested.
Gershon, right now, spreads look tight. On my screen right now, high yield spreads are back to about 383. When you're having these conversations with clients, you're focused on spreads, you're focused on overall yield. What are the conversations sounding like at the moment?
I think the conversations are a lot around default because there's a lot in the media out there that the default rates are likely going to be high in the next few years. And actually, we agree with that. But what we've been explaining to clients, I think that market participants are missing, is that high defaults do not equal low returns. You look no further than 2009. You had 10% defaults and a 60% return. And the reason was the defaults were already priced into the marketplace. So you look at today, you have about 10% of the high yield market trading at a dollar price below 60. If all of that defaults over time, just not the biggest deal in the world. Something trading at 45 and defaults and recovers somewhere between 40 and 50 doesn't have any impact on the marketplace. And in fact, a bond trading at 50 cents on the dollar with, let's say, the average 8% coupon, that's giving you a 16% yield while you wait. You might still get a few coupons. So you could have very high default and still very strong returns in credit markets. And that's kind of what we're expecting. We're expecting higher than average default. We expect them to be in the area that's already priced into the market. If there are a lot more surprise defaults, meaning defaults in bonds that are not priced as they're going to default, yeah, that'll have a bigger impact in the market. But we certainly think you can get high defaults and high returns, and that we still believe credit on a risk-adjusted basis is a lot better place to be than the equity markets.
I want to talk about that, Gershon. I've heard you mention many times over the last decade that you and I have talked about credit markets, drawdowns in equities versus credit in recessions. Gershon, can you go through that again?
Yeah, it's actually not just in recessions, John. It's any time. I'm not cherry picking here. Every single time high yield has had a drawdown of 5%. I'm not picking monthly returns or anything, an actual drawdown. Every single time, equities has done worse. Now, of course, equities do a lot better in the long run, and for long-term investors, equities are going to return more than high yield. But one has to be, on a risk-adjusted basis, we think that the high-yield market makes a lot of sense for most investors.
The one worry that I think other people have as well outside of, say, rising default rates, Gershon, you hear a lot about the maturity wall out there in 2025, that these companies will try and get ahead of that. They need to come to the market and issue debt. Is that something you're concerned about? Should we be concerned about it?
Well, I think that's a perennial concern of the high-yield market. I've been hearing it throughout my whole 25-year career. The high-yield market is set up so that you're always going to have a maturity wall because most debt becomes callable 3 to 5 years before maturity. The reason it's a little bigger concern today is because the numbers are higher, and the reason is not because of stress in the market. The reason is purely based on rate. So companies, historically, because, yields have gone down and companies that don't default end up being higher credit quality on average, it's almost always been economical for companies to call their debt early. In other words, I had a 9% coupon, I can refinance at 7%, that's a no-brainer. Well, today it's the opposite. You have a lot of companies that very smartly termed out debt at 4 and 5% a number of years ago when yields were very low. Now, that debt is callable, but the price in the marketplace might be 6 or 7%. So what does the company do there? Do they swallow, for liquidity purposes, kind of swallow that extra 100, 200 basis points? Or do they kind of gamble a little bit? I think the higher the cyclicality of a company, the more dangerous it is to gamble on that. But that's something we certainly have to watch. It's a little bit of bigger concern this time, but again, not due to any credit concerns that the market can't refinance these companies, simply due to the higher refinancing costs for companies in today's market.
It's a focus for us all going into next year. Hey, Gershon, happy Thanksgiving. It's good to catch up with you, buddy.
Happy Thanksgiving
Always
to you.
is. Thank you, sir. Gershon Distenfeld of Alliance Bernstein. Coming up on this program, another chapter in the open AI drama.
We are leading in this next generation of AI technology. We continue to be committed to OpenAI, and we continue to be committed to Sam and Greg and the team, irrespective of where they are.
OpenAI investors pushing for the return of Sam Altman, the company scrambling to avoid a staff exodus. That conversation up next.
The board has not talked about anything that Sam did other than some breakdown in communications, and I've not directly was told by anyone from their board about any issues. We definitely will want some governance changes so that surprises are bad, and we just want to make sure that things are done in a way that will allow us to continue to partner well. We are leading in this next generation of AI technology. We continue to be committed to OpenAI, and we continue to be committed to Sam and Greg and the team, irrespective of where they are.
Satya Nadella looking ahead as OpenAI goes into damage control mode. The startup reporting intense discussions underway to quell a potential staff mutiny. Roughly 95% of employees threatening immediate resignation, citing this: "Your actions have made it obvious that you are incapable of overseeing OpenAI." Silicon Valley responding the only way it knows how, on social media. Salesforce CEO posting an offer of immediate employment and pay match to any disgruntled OpenAI expats. Your team coverage starts right now. Ed back with us in San Francisco, Mandeep Singh in New York City. Ed, what is the state of play this morning?
Yeah, the state of play is that both from sources, but also you can see in posts on X, the majority of those OpenAI staff are staying for the time being. They are highly confident that Sam Altman can return, and that right now there is no point in defecting to Microsoft. I'll get to Salesforce in a second. The latest kind of hard piece of news is that Anna Mankaju, who's the Global Affairs Chief, sent out a note overnight saying that the company's leadership are in intense discussions with Sam, with the board, to make something happen. The board is digging in. The attitude towards the offer from Salesforce, but to an extent Microsoft as well, is thank you but no thank you. You know, that many of those sort of data scientists and engineers think that the best option is to dig in, stay with OpenAI, because ultimately that would lead for them and for Sam and for the company the best outcome.
Mandeep, a lot of people said yesterday, big win for Microsoft, another great win for Satya Nadella. Mandeep, you didn't share that view. Has your view changed?
No, and in fact, the longer this thing takes to solve, I think you are going to see the team getting disintegrated. And look, at the end of the day, you know, the outcome is driven by what happened, and nobody exactly knows what transpired. Yes, there wasn't communication between board and Sam Altman, but there is a concern around the safety issues, probably some IP infringement issues in terms of training the model, and I just can't see how those get resolved without, you know, the truth coming out. So clearly, you know, Sam going back to OpenAI is the most likely option, but I can't imagine the team, you know, continues to operate the way it was, and you know, them getting to GPT-5 before anyone else does in terms of the competition, which is Google and Anthropic, and you could already see some customers considering, you know, moving to these alternative large language models.
So Mandeep, you're telling me they're not just losing staff, personnel, they're losing customers?
Yeah, and look, this company was expected to do $1 billion run rate this year, and some of it is, you know, subscription revenue from consumers. Other majority of it is related to enterprise relationships, and those enterprises which were using OpenAI as, you know, the kind of the foundational large language model instead of building their own, are going to rethink their strategy as opposed to, you know, building on OpenAI versus building on these competitive platforms.
So this has been a total mess now for days. Ed, in Nadella, we have one of, if not the, probably the best CEO in corporate America, given his track record over the last decade. Ed, this is not how he does business. Did you sense with Emily Chang that this was a frustrated man in that conversation?
No. Thank you for bringing that up. I think it's critically important that he didn't answer the question on his position on how he feels about Sam going back to OpenAI. His answer was he's committed to partnering with Sam irrespective of where he is, Microsoft or OpenAI. Surprises are bad was the quote, very telling. But the key piece of news from that interview is that he does want to see corporate governance and board changes at OpenAI. You know, whatever happens from a sort of talent or personnel perspective with Sam, Microsoft still has 49% of that business. So it has a financial consideration around this. But just to answer Mandeep's thing on losing customers, you know, Microsoft has airtight licenses to use the current generation of GPT and offer it as the technological underlying embed for all of its own technology. So right now, it's sitting pretty in that sense. It's just a case of like the future. And yes, he doesn't do business that way normally.
Clearly not. Ed, thank you. Ed Ludlow, Mandeep Singh, to the both of you, fantastic coverage, to the whole of the tech team over the last weekend and the last couple of days as well. Your price action in equities right now looks like this on the S&P. We're down about 0.25% on the S&P 500. On the Nasdaq, we're down about 0.5. I'll bring you the calendar for the next 24 hours up next. Your trading diary just around the corner. 26 minutes into the session, pulling back just a touch, snapping a 5-day winning streak on the S&P. We're down about 1/4%. That's the price action. Let's get to the trading diary. Coming up over the next couple of days, the FOMC minutes coming at 2 p.m. Eastern, followed by Nvidia earnings after the closing bell. On to tomorrow, jobless claims and durable goods coming tomorrow morning, 8:30 Eastern time. Thursday, U.S. markets close for Thanksgiving and markets closing early on Black Friday. That gets you to the weekend from New York City. Thank you very much for choosing Bloomberg TV. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
Great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Tuesday, November 21st. Here are the top market stories we are following for you at this hour. All about AI, the Stan Altman drama continues with OpenAI in intense discussions to stave off a staff mutiny. As the market braces for NVIDIA earnings after the bell, just how high is the bar? Honing in on homes, Lowe's cuts its forecast as home improvement spending falls and existing home sales data is dropping now. We'll have analysis with Lawrence Yoon from the National Association of Realtors. And mark Mark's words. Veteran EM investor Mark Mobius will join us this hour to talk what's next for him yen, the dollar, and more. From Washington, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. And Guy, it is going to be another day dominated by the conversation around artificial intelligence, the role of NVIDIA in it. But first, some economic data we have to watch.
The economic data gets a big whatever. Who cares? This is a broken market. Existing home sales data tells us zip, nothing, absolutely nada. Basically, it is pretty much unchanged, 3.79 million. I'd say that was in the plus or minus, down from 3.96. The prior number revised to 3.95. That's a negative 4.1% number. But Kaylee, as you know, as we all know, the existing market is basically gummed up by the fact that everybody that had a house remortgaged it at a very low level and now won't sell. So if you want to buy one, there isn't one to buy, which means that this market is pretty much broken. So I think that's a complete non-event. The NVIDIA numbers, that's the main event for the next 24 hours.
Yeah, absolutely. This is a stock that has rallied more than 240% so far this year, guys. So clearly expectations are quite elevated. It becomes a question of what exactly is enough to meet or exceed those expectations. Just how good is good enough to keep that going?
Well, everybody expects a beat in a race. Everybody expects a beat in a race. If you don't deliver a beat in a race, you're going to get absolutely trashed. But maybe you get trashed even with the beat in the race, as you say. Expectations very high. Takes us to our question of the day very nicely. How much more juice is there left in the AI trade? Joining us now, Bloomberg's Ed Ludlow and Jackie Davalos. Jackie, I'm going to start with you. How much juice is there left, and are we going to see that juice today?
As much as there can be. I mean, even as you have one of the biggest disruptions among one of the largest AI players, OpenAI, I think the expectations are really high. And the reason for that is you're starting to see some consumer and customer adoption amongst the larger corporate players, perhaps not on a wide scale, but enough that you have NVIDIA raising their outlook quarter after quarter. And so when you think about today's earnings results, a lot of eyes are going to be on those data centers. How much supply do they have? Is that outpacing, is demand outpacing those supply figures? And frankly, some commentary around what China's controls and those curbs that were imposed earlier this year, how much of that is actually trickling through the numbers? Again, they've beat quarter after quarter, but you have that $16 billion in revenue expected today, 12 billion of that coming from the data centers, which houses these AI chip processors. So I think there's plenty of room left to go here.
Okay, so Ed, to bring you in, if there is, in theory, room, there is also room for error. Where could the error show up? Just a case of missed expectations or just not raising as much as maybe some people hope?
Yeah, last quarter, if you look at kind of gaming revenue as an example, there was some concern both on the supply side but also on the end market demand side. The way that I look at it is that NVIDIA's business is overall supply constrained on the data center side, right? In other words, all the demand that's out there, they're currently meeting it as just. And historically, I think, Guy, you and I talk about this all the time, China is 20 to 25% of that data center business. So if you're worried about the geopolitics or you're worried about the impact of the updated US technology export curbs, if they are not literally able to ship to China and book revenue on a per unit basis, there is demand somewhere else in the world that will take it. And that's why the market's sanguine.
The issue, Ed, is at some point, we are going to miss. At some point, there is going to be a moment in time where the market goes, we wanted more, and we're not going to get it, and we're not getting it. And I'm wondering if that's this quarter, next quarter, the quarter after that. When does it finally happen? And when it finally happens, what does it look like?
Well, how do we phrase it? The average of analyst estimates is for 171% top line growth on the sell side. So when you say at some point we miss, well, we'll miss relative to sell side expectations. The expectations of the buy side in the market are often very different. I know that there's corners of the market that think that 171% top line growth based on the average analyst estimate is conservative, that they could beat that by a margin of 10%. Again, remember, what we're talking about is a product that is currently the only game in town. The H100, and now actually the GH200, its next-gen accelerator, are the only sort of cutting-edge AI chips that they are producing at volume and shipping to real-world customers. AMD has announced the MI300X as a competitor to that, but it is not yet in production and definitely not in volume production. So it's not just an idea of like the growth being relative to expectations, it's that right now the world is clamoring for AI accelerators and NVIDIA is the only one building them at scale.
And that's why we have seen NVIDIA really be the poster child for AI. But Jackie, to bring you back in here, we think often about the role that chips are going to play, how centered they are in this story. But when we talk about the juice left in the AI trade, it's one thing to talk about NVIDIA and the chips. Where else could the AI trade not have hit yet? What other sectors could be beneficiaries and could have some room here?
Well, I think that's where a big question lies, in that what are some of those industries that are perhaps slower movers? The financial industry, which has been using AI for a while, but how can they really, step that up? You're seeing much more curiosity on behalf of other industries as well, where, perhaps that they're moving in this, experimental kind of way. We've heard that a lot from AI companies that, we'll test it out and see if there is this wider adoption. A lot of that is still yet to be seen. I think when it comes to the larger corporate clients where a lot of this revenue is derived, they take a much longer time to move. And as you kind of see these tools come out, it's going to take time to tinker. Even some of the biggest players out there, you have Google and Microsoft with co-pilots kind of coming out. But, you don't see this kind of coming up on a wider scale just yet.
Jackie, maybe the takeaway from the OpenAI story, and we discussed this yesterday, was that actually in many ways the algorithm, the AI bit is going to be commoditized. Everybody's going to want to do that. And therefore the value is just going to be in scaling this business and making it bigger and bigger and bigger. Who is most capable of doing that? Is it only Google? Is it only Microsoft? Is it those kinds of companies? Or could there be another company that has the potential to scale it? We know what NVIDIA is doing. It's building the stuff. Who runs the data center? Who gets the maximum value out of that commoditized business?
It's the company with the most computing power and the most data. Anyone will tell you out there that the two companies that have the most of that are Microsoft, Google, and what used to be, or what could change, I don't know, in the next few days or even hours, OpenAI had Microsoft's backing for that computing power. That's a big reason why it was able to grow so quickly and really be at the top and at the lead of this race. I think going forward, you have much more nimble companies out there outside of the big tech giants that have a chance. You have Anthropic, you have Cohere. These companies will also be vying to kind of take some of those customers that may be fleeing from OpenAI. But when it comes to just at a basic level, what it takes to succeed and get out there, it's computing power. And that's extremely expensive. So unless you have billions of dollars to power your data centers, you're going to have to accept that you might not be the number one or number two player.
Well, and Ed, finally, just to come back to you, obviously our question of the day is how much juice is in the AI trade, but I wonder how much juice is still in this juicy OpenAI Sam Altman story. We've talked about how there's active discussions now to try to stave off that exodus of pretty much the entirety of its staff. What happens next year? What are you hearing?
Yeah, I'm hearing that the door is very much open for Sam Altman to come back, but on the Sam Altman side. Right, Satya Nadella in the interview with Emily Chang last night didn't answer the question. He said he'd be happy to partner with Sam Altman, irrespective of whether he was at Microsoft or OpenAI. The question put to him was, do you have any knowledge or do you know if Sam is trying to go back to OpenAI? Remember what happened Sunday night? And it was a minute-by-minute thing, but everyone said, well, it's a done deal. The board will resign and Sam will go back. That wasn't the case. The board dug in, as we reported that they were doing. We reported that they were interviewing candidates, and that's exactly what happened. They announced an interim CEO. So I'm hearing exactly the same. The board's digging in, and if there are conversations ongoing, they're exactly that, conversations and negotiations in good faith. And real quick, OpenAI does have a run rate of about $1 billion in sales. I reported that a couple of months ago, but its compute costs are incredibly high. It's able to serve customers right now, but it needs to, from a sort of financing and cash flow perspective, get its act together.
All right, Ed, looking forward to your continued coverage of this. Thank you very much to Bloomberg's Ed Ludlow, as well as Jackie Davalos. We really appreciate it. Now, coming up, we're going to get more insight into our question of the day. Just how much more juice is in the AI trade? We'll ask Mark Connors, 3IQ Head of Research, next. This is Bloomberg.
We continue to be committed to OpenAI, and we continue to be committed to Sam and Greg and the team, irrespective of where they are.
I've never seen this in my coverage of tech in 20 years.
OpenAI is both revered and feared, and in its current state it is much diminished.
I think they made a huge mistake not understanding how valuable all of those assets are.
My number one take is that non-profit doesn't work.
As it stands, it's a win-win for Microsoft.
We all have to rely on the conscience of Microsoft. We hope they're good for the humanity, but do we really feel comfortable with that?
I think he's actually going to return to OpenAI. If he goes back to OpenAI, they're going to be more aggressive at opening these models up.
One way that we mitigate risk lending to companies like this is by separating ourselves, at least one or two steps.
I think transparency is key. That's a lesson from this weekend.
We definitely will want some governance changes so that, surprises are bad.
Those are some of our guests on Bloomberg TV reacting to the drama around OpenAI. And that leads us to our question of the day, especially in light of what's happening with OpenAI and ahead of NVIDIA results after the bell, a huge play on artificial intelligence. Just how much more juice is in the AI trade? Here now with some perspective is Mark Connors. He is 3IQ's head of research. Mark, good to see you. When we talk about how far some of these stocks have come, NVIDIA, for example, at more than 240% just this year, how much further can it go?
Yeah, so back to your question of the day, Kaylee, and great to see you again. It's been a while, as you said. The fruit has barely been squeezed, so let's look at what happened over the weekend. And it really shows you what the true tech stack is. You need the hardware to unleash the software. That's why we're all waiting bated breath on what NVIDIA does tonight. So you need that, and it's a coveted, chips are coveted. But we're finding out that you also need people to unlock the software. So that's what we found out over the weekend, is that it's not just AI. We're not having AGI take over the world. We're barely scratching the surface. We still need sound companies with teams of people working together, and no one knows that better than Sat Nadella.
Mark, great to see you as well. Sky.
Guy.
Somebody just emailed in, and I thought it was a really germane question. Do we yet fully understand what the use case is going to be for AI? We're spending a lot of money. We've got some really high-priced companies. What's it all for?
So let's take a live case. Taxes. Sorry to bring it up, but they're coming. And, you know, tax law selling is on the horizon and discussion on your channel today. Tax software has shifted from people doing it to software doing it. So now people have to find other things to do. It's an invitation to go up the margin curve. So there are so many tasks that we can do that can still be pushed down and allowing people to do other items. So I think AI accelerates the advancement of any discussion of anything we do. Think about journalism. You can say it's going to take over journalism. I don't think so. I think it allows us to go, again, I use the term up the margin curve as a journalist, as an investment strategist, as a tax accountant, and then push things below you. So that's what AI does, I think.
Well, but Mark, I think about AI in journalism, and I think about the difficulty in verifying information and on not knowing what is true or what has been created in some sort of deep fake. So it raises a lot of questions, just as it raises potentially opportunities. When we think, though, about how all of that is valued and how that value shows up in terms of inside the equity markets and the concentration at which it really is centered, take a stock like NVIDIA or really any of these big tech stocks who have been so responsible for the gains we have seen. How worried are you about that concentration risk?
As long as there's transparency. Someone earlier today, just on the snippets, was talking about transparency. It's key. So, you know, I'm in the digital asset world, and if you don't have transparency, you end up things like with things like FTX. If you have transparency, you have things like Coinbase, you know, registered good actors. So back to your question, I'm not scared about AI. What I think it'll do is the concentration will continue. So that's going to be, you can say, a problem. But NVIDIA was in the bottom quartile of the S&P 500 10 years ago. You know, now, as you said, it's up 240% or something. What I think is going to happen is you're going to have that AI meet blockchain, and you're going to have an entire new industry explode. And before I hand it back to Guy, who I know is going to hopefully test me on that, as he often does, is in 71, as I'm going back a bit, when Nixon went off the gold standard and inflation happened and you had defaults and banks were really on their heels, what opened up and didn't exist was a FX market that now trades $7 trillion a day. That didn't happen or even exist before August 15th of 71. So I'm a big believer in doors closing and windows opening, and that window is opening on because of AI right now.
1971, you've highlighted some of the negatives. I would say it was a very good year, Mark. A great vintage. Let's talk about how that therefore impacts the assets that I can invest in. What we're trying to do is figure out what's next. You've highlighted potentially the crypto impact. How does that manifest itself? Where can I make money in that space if we do see AI and the blockchain and potentially crypto interacting? Yeah. Where else am I going to be able to make money that the market hasn't spotted yet? Where are you looking to see the biggest impact coming through?
Yeah, and I have to say, I've done a load of work, and I don't say this lightly, but I do think that, you know, Bitcoin and Ethereum in that order are where the opportunities are. Because think of it, when you look at transparency, we have to wait every quarter or every year for accounting to come in and bless financials for us to then decide what the cash flow, balance sheet, and income statements were like. Bitcoin prints every 10 minutes. AI can interact with that degree of veracity and transparency. So money and intelligence meet for the first time in real time, and that's why I think Bitcoin, and then Ethereum, it's not me, it's Jamie Dimon, who's 5 to 7 years into, with a group called Onyx within JP Morgan, moving everything on chain through a group called Onyx on the Ethereum blockchain. Now it's closed off for now, but we believe it will be opened and allowed to run on an ERC20 token, throwing a little technical term out there, but that's what you'll hear. ERC20 token in JP Morgan is going to be a reality in an open blockchain in the near future.
We'll watch with interest. Mark, great to see you. Come and see us in London sometime. It'd be great to see you here as well. Mark Connors, 3IQ Head of Research. Yeah. Coming up, we're going to continue with the narrative around AI. It's the dominant theme right now, the boardroom coup and counter coup at OpenAI. We're going to hear from the CEO of OpenAI's largest shareholder. Who's that? Microsoft, Satya Nadella. What could happen next? We'll get his take. This is Bloomberg.
OpenAI's investors want co-founder Sam Altman. The startup staff is also threatening to quit, saying they'll follow Altman to Microsoft unless OpenAI's board, the board that ousted Altman, resigns. Bloomberg's Emily Chang spoke to the CEO of Microsoft, Satya Nadella, on the clamor for Altman's return and what happens next. Take a listen.
We are leading in this next generation of AI technology. We continue to be committed to OpenAI, and we continue to be committed to Sam and Greg and the team, irrespective of where they are. And, you know, I think about Sam has chosen multiple times now to work with us, and that's fantastic to see. And I think the real thing is that the capability that Microsoft has across the tech stack is what attracts great people like Sam, you know, and people like Sam and, you know, innovators like Sam when it comes to AI to come to us, and we're thrilled about it.
You incredibly quickly hired Sam as well as Greg. We are hearing that Sam wants to return. Investors want him to return to OpenAI. How would you feel about that?
Yeah, as I said, we really want to partner with OpenAI, and we want to partner with Sam. And so irrespective of where Sam is, he's working with Microsoft. And that is the case on Friday, and that's the case today. And I absolutely believe that will be the case tomorrow.
Now, we understand that to support a return of Sam Altman to OpenAI, Microsoft wants some changes to the board, to governance, to its overall contract with OpenAI, so something like this never happens again. What specifically are you looking for? For example, would you want a board seat? And if not, what else?
Yeah, I mean, I think we definitely will want some governance changes so that, surprises are bad, and we just want to make sure that things are done in a way that will allow us to continue to partner well. That's about it, right? You know, this idea that somehow, suddenly changes happen without being, in the loop is not good, and we will definitely ensure that some of the changes that are needed happen, and we continue to be able to go along on the partnership with OpenAI.
Microsoft Satya Nadella, speaking, of course, to Emily Chang, Bloomberg's Emily Chang. Katie, just fascinating. In some ways, Microsoft completely blindsided by this. Satya talking about the kind of his dislike of surprises. But I guess in some ways he had to move fast to protect his relationship with Sam Altman. He couldn't have him going somewhere else. It does kind of make you wonder about the investment, though, that Microsoft has in OpenAI and what the residual value of that is.
Yeah, I mean, they've sunk billions of dollars literally into this company, Guy, and in theory, you still have to protect that investment, even if that investment may have been, to some degree, an investment in the individual that Sam Altman is. So if you have a threatened mutiny of 770 individuals that work at OpenAI, try to bring them over, then what is left of what you invested in? I feel like we still have so many questions that remain unanswered.
You do wonder whether AI would come up with a better way of handling this situation. You would certainly hope so, because this hasn't been handled. Precisely. How would you handle this situation should be the perfect question. We're going to go back to the mortgage market. We're going to go back to the housing market next. We've just seen some data basically confirming that the existing market in the States continues to be basically broken. Lawrence Yun, National Association of Realtors Chief Economist, joining us next. This is Bloomberg.
We're about an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. Abigail, what's going on in stocks as we wait for NVIDIA after the close?
Well, Kelly, we are looking at the first down day for the S&P 500 and many of the other indexes in 6 days. Over the 5 days previous to today, the S&P 500 had been climbing up about 2% over that time period, a little more than 2%. But today we're looking at this point at nearly 0.5% decline. So investors are a little bit nervous, and I think that you honed right in on what they they could be nervous about, having to do with NVIDIA. But it's not just NVIDIA that we're seeing a little bit of a pullback ahead of that report after the bell. It's big tech in general, despite the fact that we have yields down. Take a look at Amazon, down 3%, its worst day in more than 3 weeks. Microsoft down 1.5% after just recently hitting a record high. The parabolic uptrend that we've had in tech stocks does seem to be reversing today. Broadcom down 1.7%. Chinese regulators requiring them to provide some information about to meet some certain conditions in order for their $61 billion deal with VMware to be approved by Chinese regulators. And then here is NVIDIA, worst day of the month, down 2.3%. Investors looking for a little more than $16 billion, $3.37 in adjusted earnings. The biggest question, though, of course, is whether or not they can put up another blowout quarter and guide. In May, in particular, the stock had a 24% gain on a blowout quarter. Take a look at this chart. You can see since that blowout quarter, and here's that gap higher. So this type of a gap, when it's so big like this, they sometimes will fill, but in terms of that uncertainty there, positive upside, investors having no idea that they could put up that kind of a blowout outlook. But since then, we've basically been in this range. So the stock just slightly above it. However, take a look at the RSI coming out of overbought territory, well above the 200-day moving average. This chart may suggest, Guy, that the quarter and the outlook that that NVIDIA puts up, it may be fine, but it may not quite meet the expectations. The stock up more than 240% on the year, or maybe it'll come in the days ahead. On the other hand, who knows? Maybe it comes out of the range. But I would say that RSI points to at least a little bit of consolidation on the part of NVIDIA.
Seems to be blowing past all expectations. Can it go out of that range? Abigail, thank you very much indeed. It is the main event. That's what we're going to be watching. While we wait, there's plenty of things to talk about, though. The housing market remains pretty broken. So sales of existing home sales in the US dropping to their lowest level since 2010. 2010. We're talking about contract closings here at 2010 levels. High rates and very high prices, very much discouraging home buyers from buying homes if they can find a home to buy that's not new. Joining us now, the chief economist of the group that puts that data together, Lawrence Yun of the National Association of Realtors. Lawrence, this continues to be a broken market. You've got super high prices because nobody's moving, and I'm wondering how real those numbers are. And you've got basically everybody locked into super low rates so they won't move. What fixes, what provides some sort of grease to the gears to get this market moving again?
Well, mortgage rates have to come down. Now, the bond market looks like they already pivoted. The Fed is still indicating that maybe they will not cut interest rate or considering raising interest rate, but the bond market is essentially saying no, things are done. From now on, the mortgage rate will be on a descending pattern. Today's 4.4% on 10-year Treasury. That's meaningfully lower compared to 5% 1 year ago. Now, of course, we're not going to get back to the mortgage rates of 3 or 4%, but if the mortgage rates was to say come down closer to 6% next year, I think there will be many home sellers who have been delaying and delaying their move. They have additional child in the family, maybe they turn 65, looking towards retirement years. All this delay in potential sales, I think will begin to appear next year.
Okay, so that could mean theoretically, Lawrence, that more supply is going to come online, maybe ease up a little bit of the inventory issue. But if rates still remain relatively elevated and potentially the reason they're going down is because the economy has softened materially, which is why the Fed is cutting, does that mean then we're going to have a demand problem?
Well, with the rates going down, we always have additional marginal buyers coming into the market. The cash transaction, interestingly, is a cyclical high. 30% of all transactions recently are all cash, essentially bypassing the mortgage market. Pre-COVID, it was 20%, but the home sales being this slow, while at the same time hitting at all-time high home prices for the month of October. This is a very strange market dynamics that we have currently. Homeowners are very happy. Home buyers are frustrated from affordability challenges and lack of inventory. Only way to fix it is for the rates to steadily come down.
Kaylee Lines, I think, is the perfect person to talk to in this kind of environment, because basically I think she embodies all of the things that are wrong with this market. She wants to buy a house, can't buy a house, can't find a house, spends the whole time basically on websites looking at houses. Kaylee, from your perspective, this genuine kind of interest, what does the market look like?
Well, there is just not a lot of inventory out there. As you say, guys, spend a lot of time crawling these websites. I think I am familiar with pretty much every listing in the 2 cities in which I would theoretically like to buy a house, because there's just not that many of them. They're priced really high, and then of course you layer on the rate on top of that. Your options are either pay an arm and a leg for a house at an incredibly high rate, or buy one you can't afford and have to fix it up. Either way, it's not a win-win situation, hence why, Guy, I remain a renter.
Yeah, exactly. And you do wonder, yeah, Lawrence, you do wonder, when the market starts to freeze up, I suspect that Kaylee is not alone. How much demand will there be?
Well, the current sales activity is well below pre-COVID. Now, if we can get a 20 or 25% jump, we only go back up to pre-COVID condition. And some of the good news is that supply is beginning to turn around. I mean, we see the builders getting a little active. Even though it takes a little longer to complete the home, there will be future supply to the market. We see some of the incentive to convert the disused commercial buildings, whether empty office building, empty shopping units, into senior housing or condominiums. That will be additional supply to the market. Now, sometimes it is trade-up market, so some seniors move into those senior housing, thereby releasing their homes onto the market. So all add to the supply, but clearly Americans are not moving. They're sort of stuck. And this is not the American way. American way is moving and moving.
Well, Lawrence, when we think about supply, typically you introduce more supply to the market, prices come down. That's just the way supply and demand dynamics tend to work. But if we're talking about people like me, all of this pent-up demand that we're going to have, who've been sitting out buying for the last several years, does that essentially mean that even if rates come down, prices are going to continue to remain elevated?
It depends on the supply. So if the supply is restricted, we all know economics pushes home prices to another record high levels. But if we have adequate supply, which I really hope that we get more supply, and even through some policy incentives, maybe some of the capital gains exemption, which has not been changed for 25 years for the homeowner sales, that little exemption, $250,000 for a single person, if it can be just simply indexed to inflation, we will have more listing coming onto the market. So, some policy measures along with the builders' natural response to this housing shortage, we will get that more supply. And for some Americans who have that flexibility to work more remotely, maybe they're considering more rural areas, small towns where homes are much more affordable and inventories are more readily accessible.
All right, Lawrence Yoon from the National Association of Realtors, thank you very much for joining us. Guy, I'm not sure that conversation leaves me much more optimistic about my prospects, because I also work in a city. I can't move 2 hours away into
you can't go to some rural destination, can you? That would be a tricky thing for you, given your hours and how hard you work. I'm just wondering if there's an AI solution here as well. I keep coming back to this. Some sort of an AI. ChatGPT's got to be able to solve this problem. If it can't solve this problem, we come back to the use case. What is it good for?
Yeah.
Must be able to find Kaylee Lines a house.
Oh, I hope so. That would be a wonderful use case for me selfishly, but of course we're still trying to tease out the use cases and how you value them entirely, and we'll continue that conversation throughout this program. Coming up, though, we have a different conversation to have regarding emerging markets. Argentina's stocks are rallying following the decisive win of Javier Milei. Noted emerging markets investor Mark Mobius says this can be an opportunity. He'll join us next with his thoughts. This is Bloomberg. Bloomberg. Well, Argentina stocks are soaring as local markets reopen following the decisive victory of Javier Milei. Renowned emerging markets investor